So I want to talk to you about that. The net outflows from the TLT that tracks the 20-year. Also some new info right here. Looking at bonds, actually saw its biggest weekly outflow. Treasuries I'm talking about in 11 weeks of $1.2 billion. What do you make of that? I thought investors were piling into the bond market for safety.
Well, it depends on what segment of the bond market. So in long dated exposures like the 20-year treasury exposure or even 10-year exposure, you would only go into those right now if you were really confident that none of this economic data that's going to come through is going to weaken the economy. So bond markets are an excellent reflection of sort of the sentiment in the economy and in markets. And so that's why you're seeing a lot of concern and movement out of the long end. Also, the yield curve, sort of what you're being compensated for being in the long part of the curve right now is probably not as risk averse as if you were to go into the short end. So that's people move back and forth from the long end to the short end often, and that's what that reflects.
All right, well, speaking of kind of that positioning when it comes to the bond curve, when we're looking at the 10-year, right now where we're seeing it at that yield, is this an attractive entry point? And also, what about corporates? We're talking a lot about inflation, maybe even stagflation, and also weakness in the economy. What kind of corporate bonds are attractive right now?
Yeah, so we actually still view that the economy is showing signs of resiliency, especially when you look at it through the filter of a bondholder and a corporate bond issuer. So what you're looking for in bond issuance is whether there's distress in a company's ability to pay their interest, to pay their debt. And so we haven't seen that develop. In fact, the balance sheets of corporations have been really strong through the last 2 years. And even if the economy weakens, or as you were mentioning about different economic data coming in as softer, we're going to need to see more data to understand if this is a soft patch or something more. But real broad distress in a corporation's ability to pay back their debt is probably not something that's presenting itself. So that means there's a lot of opportunity to reach for this income in fixed income. And in corporates, we think that if you're invested in high quality corporate debt, like investment grade debt, you should be reaching for that yield all the way out to like a triple B space. And as well, as we're a big fan of reaching even further into high yield as you look at these income rates that are topping over 11% at the highest. That income offsets a lot of volatility in your portfolio. And these markets are really, really good reminders to diversify your portfolio right now.
All right, so you're saying you still see a lot of strength in the economy, but what signals is the bond market telling us? When we're seeing these moves when it comes to yields, how should we interpret that when it comes to the bond market? A lot of times we hear people say the bond market's bigger and even smarter than the stock market.
Well, I mean, people have enjoyed extraordinary returns in the stock market over the last 15 years, and they've gotten used to year-on-year returns. I mean, you challenged me the last time I was on here. Why would you want to be in the bond market and when you can get such amazing returns in the S&P 500 for 2024? But this is a really good reminder that, there's a lot of concentration in your portfolio as you keep piling into those equities. So in bonds, what we're at right now is you're at peak, you're at high interest rates. You have corporate strength in their ability to pay their debt. And so you're enjoying these big income levels that you can put into your portfolio to offset risk that you have inherently in those big equity positions. So if you're looking for, a place where your portfolio can be more resilient, you should be allocating more to fixed income right now. And we've been advocating for that. Our very top pick, by the way, is to invest in private credit. And that's because private credit has an extremely low correlation to the public markets, both fixed income and equities.
Before we get on a tangent, just very quickly, can you bottom line it for us? When we're seeing these action in the bond market specifically, yields going down about 50 basis points from their highs so far in 2025. What does that say? Is that a sign that the bond market's worried about the economy? Is that the sign that the bond market's no longer worried about inflation? What are we getting from the bond market?
That is absolutely saying that investors have concerns about this market and this economy and sort of the outlook of the economy. That's absolutely saying that there's concerns about it. I think we are very cautious in saying we need to see more data to understand what we're heading into. And even in the jobs data that'll come out today, whether or not that's fully reflective of the future outlook and whether or not some of these weaknesses actually develop. We've seen this before over the last 2 years. You really need to go by the academic data, and when that turns, that's where you'll be looking for, your
Okay.
next action. But we still say fixed income and at these high levels are really important to be
Okay.
putting into your portfolio right now.